Welcome, everyone. My name is Kenny Birch. I'm a tax director in our mortgage banking tax practice. Over the past few years, we've seen an increase in M&A activity in the mortgage industry. Our goal is to help IMBs prepare for these potential transactions by releasing a two-part video series covering M&A activity. Video 1 will focus on the audit or GAAP implications, while video 2 focuses on the tax implications of these transactions. When companies think about M&A, they often focus first on price, strategy, and legal terms, but accounting can be just as important. GAAP conclusions can affect how the transaction is recorded, what assets and liabilities appear on the balance sheet, whether goodwill is recognized, how future earnings are impacted, and how confident a buyer feels during diligence. Here to discuss this topic with me today is Shane Votto, a manager in our mortgage banking audit practice. All right, Shane. Based on the M&A activity you've seen over the past few years, what's the biggest theme you've noticed?
One of the biggest themes we have noticed over the past few years is that the accountant often hinges on understanding the true substance of the transaction rather than just simply relying on how the deal is labeled in the purchase agreement. Determining whether a transaction should be accounted for as an asset acquisition or a business combination under ASC 805 is frequently the most critical step that we see. As a result, it's essential to thoroughly read and understand the agreement in its entirety, including any side agreements, contingent consideration arrangements, employment provisions, and other deal terms that may impact the accounting treatment. The three most common matters we see that are heavily impacted by ASC 805 are contingent considerations, like contingent earnouts, goodwill, and transaction costs. We could host a separate webinar just for these three matters, but I like to use this time to provide a brief summary. And I'll touch on contingent considerations in more detail later on. As it relates to goodwill, remember that goodwill is only recorded in the event of a business combination. For an asset acquisition, any additional fair value in excess of the purchase price is allocated to the assets acquired. Transaction costs are capitalized and are considered a component of the consideration transfer. If a deal is determined to be a business combination, these costs are expensed as incurred and are not included in the purchase price consideration. With that said, it is important to note that debt and equity issuance costs are treated a little differently. Another major theme is the increase in importance of evaluation and purchase price allocation. Once you've determined the nature of the transaction, we highly recommend engaging a qualified third-party evaluation specialist to determine the fair value of the acquired assets and assumed liabilities. These valuations can significantly affect the amount of goodwill recognized, future earnings through amortization or impairment, and the overall financial reporting outcome. In addition, transactions have become increasingly complex, with earnouts, contingent considerations, debt modifications, and other unique deal structures requiring careful analysis early on in the process. And the companies that navigate acquisitions most successfully are typically those that involve accounting, valuation, and legal professionals early and focus on understanding the transaction substance before addressing the accounting mechanics.
Thanks, Shane. Obviously a lot there. We see a lot of time spent on purchase price allocations. What advice do you have for buyers and sellers in that area?
Advice I would have for them is just knowing that the purchase price allocation is where the economics of the deal get translated into the financial statements. If intangible assets, mortgage servicing rights, contingencies, or assumed liabilities are not properly identified and measured, goodwill may be overstated or even understated, and future earnings may be affected through amortization, fair value changes, or impairment. Getting both sides to understand allocations and impact is very, very important.
Similarly, what might buyers and sellers need to consider around earnout structures and the purchase price?
Yeah, it's a good question, Kenny. Earnouts can be especially tricky because the accounting depends on the substance of the arrangement. Some earnouts are additional purchase consideration, while other earnouts are really compensation for post-closing services, particularly where payments are tied to continued employment. That distinction can affect whether the amount is part of the purchase price or recognized as compensation expense after the deal closes.
Thanks, Shane. It seems like confidence would be a big motivating factor for a buyer to potentially move forward with a transaction. Can you speak to what might help a buyer gain that confidence?
Definitely. One of the biggest drivers of a smooth transaction is creating buyer confidence early, and that starts with clean financials and a commitment to transparency. Buyers want to see consistent, accurate, and timely financial reporting, and they want management to be able to clearly explain what they're seeing. So things like delayed closes, unexplained fluctuations, unsupported balances, or inconsistent reporting often leads to additional diligence questions and can raise concerns. Management should be prepared to explain revenue trends, changes in profitability, significant one-time items, valuation adjustments, and any shifts in business strategy too. If management can't easily explain a balance or trend, it's likely a buyer will spend significant time digging into it.
That's a good point, Shane. I think everyone's heard that saying, no one likes surprises. How do you think that phrase applies to an M&A transaction?
Yeah, as I mentioned, buyers want and expect transparency. Issues that surface unexpectedly during diligence often have real consequences. Surprises are not necessarily deal breakers, but they do prolong the time it can take to execute a deal.
Yeah, another great point. Clean financials directly impact the buyer's confidence. Do you have any examples of what those surprises might look like?
From an accounting standpoint, this could result in unreported liabilities, compliance issues, unresolved audit findings, unsupported estimates, or even incomplete reconciliations. These issues become much more problematic when they are discovered by the buyer and sometimes the auditor too, rather than identified and addressed by management beforehand. The practical takeaway is conduct your own diligence before the buyer does. Companies that maintain clean financial records, understand their numbers, and proactively identify and address potential issues are typically in a much stronger position throughout the transaction process. Finding and resolving issues internally is always less expensive, less disruptive, and more favorable than having a buyer uncover them during diligence.
That's a great point. With respect to financial reporting, what does it mean to be ready for a potential transaction?
Approach a potential transaction with the same level of rigor as a year-end audit. Ensure all key accounts are fully reconciled and supported by well-prepared schedules. Even evaluate the collectability of receivables and adjust allowance estimates where necessary, things of that nature. Perform a comprehensive review of key inputs behind your locked pipeline, including cost to close, pull-through rates, to confirm they're reasonable and aligned with your business model and loan portfolio characteristics. Significant estimates and judgments should also be thoroughly documented and supported with references to the applicable accounting guidance. From documenting how MSRs are recorded to how your company accounts for potential loan losses via the loan loss reserve, having memos for these significant estimates and those accounts that make up the majority of your business really goes a long way. And taking those steps in advance can significantly enhance your organization's readiness for a potential transaction and help facilitate a smoother diligence process.
Thanks, Shane. Another area I'd be interested to hear your thoughts on is what areas buyers tend to scrutinize the most. Do you have any thoughts there?
Definitely. Areas that often receive the most scrutiny include loan-related assets and liabilities, those servicing assets, reserve methodologies, hedging performance, warehouse finance and arrangements, fair value measurements, and really any significant contingency or commitment. From our experience, buyers are generally looking for consistency, strong documentation, and repeatable processes. If a meaningful portion of the purchase price is tied to a significant estimate, such as MSRs, reserve balances, or fair value measurements, buyers need confidence that the methodology is sound and can withstand scrutiny. One practical way to strengthen that confidence is through independent third-party evaluations of those key assets that are being acquired, particularly when fair value estimates are a significant component of a transaction. Again, ultimately, buyers want assurance that the critical assumptions and processes underlying the business are well-controlled, supportable, and sustainable post-acquisition.
All right, Shane, I want to put you in the shoes of a prospective seller. What would you be doing, say, 6 to 12 months before a potential transaction if you were contemplating a sale?
Beyond what I mentioned previously, whether you are a one-person accounting team or a fully staffed accounting and finance department, documenting those controls and key processes is critical. There's often significant nuance in how organizations approach complex transactions and significant estimates, especially within the mortgage industry. So having a robust and well-organized documentation really helps buyers understand those processes, reduces diligence-related questions, and can contribute to a smoother and more efficient transaction process.
Okay. To follow up, are there any specific questions a buyer considers as part of the process or any hidden costs?
Yeah, definitely. From a loan level perspective, the buyer is often assuming significant legal and credit risk as part of the transaction, along with the exposure to future loan losses, early payoffs, and early payment defaults, just to name a few. They're evaluating not only the current performance of the loan portfolio, but also what potential losses or obligations could emerge after the deal closes. And those are those hidden costs because they may not be immediately apparent from the financial statements alone. For example, there could be pending litigation, repurchase exposure, or other contingent liabilities that were not fully disclosed or understood during the diligence process and ultimately become the buyer's responsibility after closing. And that's really why transparency is so important. Buyers aren't necessarily looking for perfection, but they do want confidence that they have a complete picture of the risks they're assuming so that there are no surprises once the transaction is complete.
Thanks, Shane. As we wrap up, are there any other areas you wanted to highlight?
Yeah, I would just like to stress the importance of involving both your audit and tax professionals as early as you can. We understand there's a high level of confidentiality involved in these deals, and often the buyer and seller's accounting teams are the last to get involved. But the earlier we can get our eyes on the agreements and deal documents, the sooner we're able to identify the accounting implications and address any potential issues that may exist. A third-party evaluation is also highly recommended as it helps substantiate the purchase price, assess the fair value of acquired assets and liabilities, evaluate future cash flow assumptions, and identify any potential impairment concerns related to intangible assets. Also, be on the lookout for contingent considerations, earnout arrangements, and prepaid compensation provisions that are embedded in the agreements, as these are quite common in the M&A transactions we've seen from our side. A common mistake we see made is how contingent considerations are recorded. Often, the buyer immediately assumes an obligation that's dependent on future conditions being met is a contingent consideration, when in actuality, it's compensation. We also see the opposite of this as a common mistake. So the details really matter. Make sure you thoroughly read the agreements and reference the correct guidance. In this instance, ASC 805, prior to recording the transaction. Lastly, management should document whether the transaction qualifies as an asset acquisition or a business combination, as this conclusion drives the applicable accounting guidance and significantly impacts purchase price allocation and overall transaction accounting.
Thanks, Shane. Those are all great areas to mention. Do you have any parting words as we wrap up?
Yeah, as a final thought, I would just like to reiterate that we are here to help as needed. Over the past few years, we've seen a lot of M&A activity, and one of the most consistent themes has been that transactions tend to go more smoothly when advisors are involved early in the process. So thank you for tuning in today, and please don't hesitate to reach out if we can be of any assistance.
Absolutely. And thank you, Shane, for joining. You provided a lot of really helpful information for our audience. Please tune into our next video where Gina Jackson and I will cover important tax considerations involved in M&A transactions.